Last week, WTI reached an 11-month high while Brent crude reached $90 a barrel for the first time since last November. The explanation is that Saudi Arabia and Russia announced they would continue to limit the supply of oil through the end of the year. The choice was not very shocking. The length of the extension was a surprise. It implied that OPEC Plus's largest oil producers had stopped tinkering. They were going to receive the increased prices they demanded. With that action, the fragile thread that holds US-Saudi relations together became even thinner. Last year, the Biden administration sold nearly 200 million barrels of crude from the Strategic Petroleum Reserve to quell the rise as oil and fuel prices soared in the wake of US and EU sanctions against Russia for its invasion of Ukraine. It was successful, too, not least because it turned out that Russia's oil exports were unaffected by the extensive sanctions, which reduced oil prices. Credit was given to the White House. Now that the next election is only a year away, prices are rising once more, and the SPR is at a 40-year low. And the Saudis have made it abundantly obvious that their priorities no longer coincide with those of their international allies. The Saudis don't now have many allies in Washington. They run the risk of turning into Exhibit A if Washington decides to once more point the finger at someone for high gas prices or a sluggish economy, Eurasia Group analyst Rod Al-Qadiri told the Financial Times this month. In fact, prices are rising. Despite the minor increase in price, the mere fact that it exists raises some red flags because after Labor Day, demand for gasoline falls. What's worse, though, is that, per Argus statistics published by the Wall Street Journal, diesel prices have increased by 40% since May. The sort of crude that is being removed from the market has a greater impact on diesel, according to Alan Gelder, Vice President for Refining, Chemicals, and Oil Markets at Wood Mackenzie, who spoke to the Wall Street Journal. Compared to lighter crude oils, Saudi Arabian oil offers a better yield for diesel. This loss increases the economy's costs. All of this is taking place as optimism grows that the US has a strong chance of surviving the fallout from last year's events and avoiding a full-blown recession. It has been anticipated that the Fed will stop raising rates later this year as a sign of these hopes. Thanks to the most recent Saudi cut extension, which has sparked concerns for the world supply, it now appears that gasoline prices will replace rate increases. Diesel serves as the literal fuel for every economy, and as a result of the sharp increase in fuel prices, everything else is also becoming more expensive. This would eventually result in less consumption. Especially if crude prices continue to rise and bullish forecasters are correct. All of this would put greater strain on relations between Saudi Arabia and the US and solidify the idea that Saudi Arabia is changing course, just in case membership in the BRICS wasn't already obvious enough. The immediate future of American energy security does not look promising given this strain. According to the FT, it doesn't seem good for Biden's chances in the 2024 elections. However, this might be the more minor issue. Due to the scarcity of significant suppliers of the kind of heavy crude that US refineries require to increase their production of diesel. The list, which also includes Iran, Venezuela, and Canada, should make it plain why Washington needs to keep cordial ties with Riyadh. First, though, it's important to mend these ties after President Biden accused the Saudis of being responsible for last year's price surge, warned them, and then went and fist-bumped Crown Prince Mohammed bin Salman, which many observers at the time believed to be the Saudis' breaking point. The fact that the Biden administration lacks a robust SPR to deploy this year to control gas prices is an even bigger concern for them. The reserve is at its lowest point in 4 decades, and even when prices were in the range that the administration desired, the anticipated replenishing never materialized. This implies that there is considerably less opportunity for justification while prices are rising. It didn't work the first time, and it won't work this time to blame the Saudis. Neither would point the finger at the Russians because they have become a frequent target, which lessens the impact of each subsequent finger pointing. There aren't any other easy targets to point the finger at for the high pricing than these two. The Biden administration is going through a difficult period once more. A reliable crude supplier and geopolitical ally in the past, the Saudis are now proving that, in the words of former New Jersey Governor Chris Christie, "You won't have a good relationship with us, well, we'll have a good relationship with Russia." With the notable exception of Canada, whose own federal government isn't renowned for being particularly supportive of the country's oil industry, the other major exporters of the heavy crude required for the creation of diesel are nations that are subject to US sanctions. It won't be far-fetched to claim that the Biden administration is in a pickle that is mostly of its own making. The hardest to escape from are these. According to people familiar with the preparations, Saudi Arabia's oil giant Aramco has assured at least 5 refiners in North Asia that it will supply the full contracted volumes of crude oil next month. Reuters reported this on Monday. Despite the prolonged output decrease, Aramco, the biggest exporter of crude oil globally, will deliver the full quantity North Asian refiners have requested under their term contracts. Saudi Arabia announced last week that its 1 million barrels per day (BPD) reduction would continue until December. The action strengthens the precautionary efforts made by OPEC Plus countries with the aim of supporting the stability and balance of oil markets, according to the kingdom. The kingdom then made another formal price hike announcement for its crude oil shipping to Asia in October a day later. Arab Light, the most popular oil grade in Saudi Arabia, saw a 10-cent increase in price per barrel to $3.60 per barrel over the Oman/Dubai average, the Middle Eastern benchmark against which grades headed to Asia are priced. Nevertheless, the price increase was significantly less than the 45 cents per barrel increase that was anticipated by 5 refining sources surveyed by Reuters. Brent oil prices have risen above $90 per barrel for the first time this year as a result of the extension of the Saudi production cut and Russia's promise to similarly prolong its 300,000 BPD export decrease until the end of this year. According to Vortexa, the market hasn't yet fully absorbed the effects of Saudi Arabia's additional production cut, which might result in a significantly tighter market if the top crude oil producer in the world maintains low export levels. If Saudi Arabia keeps export levels as low as they were in August, David Weck, chief economist at Vortexa, wrote in a report this week, it might be able to tighten the market on its own in the fourth quarter, even without the assistance of other OPEC Plus members. The International Energy Agency, IEA, warned on Wednesday that the Saudi-led cuts to OPEC Plus oil supply would cause a significant supply shortfall on the market in the fourth quarter of 2023, which would cause a spike in oil price volatility. Higher crude oil production from nations outside of the OPEC Plus coalition has so far this year been able to partially offset the OPEC Plus cuts. The IEA stated today in its closely followed oil market report for September that from September onwards, the loss of OPEC Plus production, led by Saudi Arabia, will drive a significant supply shortfall through the fourth quarter. According to today's IEA report, oil prices were relatively stable during August, with volatility reaching multi-year lows. However, a quiet August was followed by the announcements of supply cut extensions in early September, which increased prices and volatility. Until the end of this year, volatility may rise even further, the agency predicts. The market would move to a surplus if the two OPEC Plus leaders unwind the cuts in early 2024, according to the IEA, but oil stocks would still be at uncomfortably low levels. Given the weak economic climate, this raises the possibility of another spike in volatility, which would not be in the interests of either consumers or producers. It commented on the rise in oil prices and its earlier warnings about an already constrained oil market, saying that the Saudi-Russian alliance is proving to be a strong threat to the oil markets. According to IEA estimates, observed world stockpiles fell by a staggering 76.3 million barrels, or by 2.46 million BPD, in August. What are your thoughts on Saudi Arabia and OPEC Plus, and do you think they can crush the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.